afternoon, good evening to all of you. It's a real pleasure having you here again today for the second day of our symposium. It's a special pleasure to give the floor to our Minister of Finance, Mr. Daniele Franco. Minister, thank you very much for having taken your time to be with us today. It's a great honor, and the floor is yours.
Okay, thank you very much, Magda. Ladies and gentlemen, I would like to thank the two co-chairs and Magda for the kind invitation to open this second day of discussion of the high-level symposium of the Global Partnership for Financial Inclusion. It is a pleasure for me to join you today. I would like to concentrate my remarks on three aspects: the G20 digital agenda, and more in particular on digital financial inclusion and the role of the GPFI. And finally, I would like to give you a few numbers of the investment supporting the digital transition in Italy. Well, the COVID-19 pandemic is having a significant economic impact on the most vulnerable and underserved segments of the society, as well as on smaller firms. This is a threat to the progress in the implementation of the 2030 Agenda and its Sustainable Development Goals. Almost 100 million more people fell into poverty in 2020, an equivalent of 255 million full-time jobs were lost, and an additional 100 million children and youth fell below the minimum reading proficiency level. Increasing inequalities are hampering our ability to achieve prosperity for all. Under the three broad interconnected pillars of the G20 Italian presidencies, which are people, planet, and prosperity, sustainable development has been placed at the core of the G20 agenda. In a deteriorating economic environment, financial inclusion plays an important role. Greater financial inclusion of households and small firms can help in managing better financial resources over time, facilitating consumption smoothing and investment, thereby sustaining growth and contributing to the reduction of income inequality. The Global Partnership for Financial Inclusion, GPFI, has served as one of the main pillars of the 2021 G20 Development Agenda. The priority of the GPFI this year has been to evaluate and address the impact of the pandemic on individuals and micro, small, and medium-sized enterprises, leveraging on digitalization as possible source of financial inclusion. I will say a few words on digital financial inclusion. The pandemic has accelerated the pace of digital transformation. In so doing, it is exacerbating the risk of increased inequalities and exclusion of those that are not digitally connected. New forms of exclusion caused by digital divides may represent a challenge for both individuals and smaller companies. They should be prevented in order for consumers and firms to reap the benefits of digital services. The Italian G20 presidency put digitalization at the center of its agenda. Allow me to mention two of the works undertaken throughout 2021. First, last July, G20 finance ministers and central bank governors endorsed the G20 menu of policy options on digital transformation and productivity recovery. The menu provides a policy option, shares good practices, promotes inclusion, and sheds light on the key role of international cooperation to make use of the growth opportunities of digitalization. Second, the Italian G20 presidency has developed, with the support of the OECD, the G20 guidelines for financing and fostering high-quality broadband connectivity for a digital world, which are expected to be endorsed at the October G20 ministerial meeting. The fundamental notion behind this stream of work is that a fully fledged digital transition cannot be achieved without investing in advanced and well-functioning digital infrastructure and smooth connectivity. The availability of safe and reliable infrastructure is fundamental for achieving digital financial inclusion as well. It is therefore crucial to accelerate investment in infrastructures to help individual and SMEs owners enter and participate in the formal digital economy in a safe and efficient manner. The huge potential of digital financial services has clearly emerged with the pandemic. Lockdowns and social distancing measures introduced to contain the spread of the virus have accelerated the transition from analog to digital on many fronts, including financial ones. Not everyone has had equal access to these opportunities. Unless promptly tackled, the digital divide may exacerbate existing inequalities. Besides highlighting the necessity of having accessible digital infrastructure and connectivity, there are other crucial enabling factors for reaching a satisfactory digital financial inclusion, that is, the adequate equipment of digital financial literacy. These consist in a combination of awareness, knowledge, skills, behaviors, and attitudes necessary to make sound financial decisions in a digitalized world. It crucially hinges on the two types of literacies. Let me start from financial literacy. The increased access to innovative, complex, low-cost financial instruments and services opens up new opportunities for improving overall levels of financial inclusion. However, it also brings new challenges for final users and may expose them to newer risks and threats, particularly when compared to traditional financial products. Such a shift would inevitably require higher level of financial literacy. Enhancing the role of financial education is important not only in emerging markets and developing economies. Financial illiteracy is generally linked to poverty, inequality, social exclusion, and social immobility. Within the euro area, mortgages constitute the largest share of total debt in the majority of households. It is therefore crucial to understand the consequences of indebtedness, especially for the most vulnerable groups, such as young families, low-earning households, and first-time homeowners. At the same time, moving to the topic of digital, the emergence of new financial technologies has been changing the way consumers and SMEs choose banking services, make payments and financial decisions, or seek financial advice. Many have access to digital finance, but lack digital skills or trust in the digital world. This especially applies to women, elderly, and other underserved and vulnerable groups. Policies for enhancing digital financial literacy may include using behavioral insights in financial education, introducing targeted digital campaigns, or adding financial competencies in school curricula. All in all, disparities in digital financial literacy should be properly addressed, as they may become a driver of precariousness and inequality. Greater financial and digital literacy is necessary for a more inclusive recovery. Efforts to enhance digital financial literacy for all population groups, including by leveraging technological solutions, are critical to scaling up sustainable digital financing ecosystems. On this, I welcome the effort and results of the GPFI, which has produced a menu of policy options for digital financial literacy and the financial protection of consumers and MSMEs. Financing digital financial inclusion beyond the COVID-19 crisis to be submitted for approval by Minister of Finance and Central Bank governors of the G20 in October, and eventually to the G20 leaders at the end of October. Let me finally move to a brief description of the digital transition and digital inclusion agenda at domestic level, at the Italian level. In the next few years, Italy will consistently step up resources to promote an inclusive digital transition, also relying on the ambitious package of investment and reforms laid out in the Recovery and Resilience Plan. As you might know, the Italian plan mobilized resources for about 222 billion euro. Alongside tackling the economic and social impacts of the COVID-19 pandemic, sustaining the digital transition is one of the stated objectives of the Next Generation EU project. Digital investment account for more than 25% of the total. Projects include incentives for the adoption of innovative digital technologies in the private sector, and more broadly for the modernization of the productive system. A balanced digital transition requires also a profound organizational and technological change of the public administration. Significant investment will be directed at strengthening cybersecurity. Finally, the plan will grant ultra-broadband and high-speed connectivity services at the national level. A key sector-specific intervention promoting the adoption of digital technologies is the full deployment of the electronic health record. Education is a backbone of digital transformation. The plan directs a considerable investment to enhancing digital competencies across the whole school curriculum. There is also a specific 2 billion project that, among other things, will finance classroom transformations into connected learning environment and will wire 40,000 school buildings. These initiatives aimed at improving infrastructures, services, and competencies will promote greater inclusion and awareness in the access to digital instruments, including financial ones. Finally, I would like to leave you with a message of optimism. The pandemic has significantly transformed our economies and societies, and has also accelerated the digitalization of financial services with a massive increase of digital offers, which is expected to continue in the years to come. Moving forward, more needs to be done to exploit the opportunity provided by the digital transformation. Thanks also to the GPFI, we have a clear picture of what needs to be done in terms of policy and investments to enhance digital financial inclusion, especially for the most disadvantaged segments of the population. Thank you very much for your attention. I wish you all the best for your work.
Thank you very much, Minister Franco, for your words. We do hope that the GPFI work on both digital financial literacy and financial consumer and Msmes protection will somehow help address some of the worries, some of the issues that you raised, and specifically will help in ensuring that digitalization will be a source of further inclusion and does not generate new forms of exclusion. So thank you again. It was a great pleasure and an honor. And now I'll give the floor to Anna for chairing the first session of today.
Thank you very much, Magda. Thank you very much, Minister Franco. And good morning, good afternoon, good evening, everyone in this room, and everyone, all participants who joined us online. I would like to say that today the first part of our symposium would be mainly devoted to the ways of supporting financial resilience, financial inclusion, and transformation through digital financial literacy. But of course, we will have many different subjects within this area. We will present findings, the OECD will present findings of the new report. We will have a few interventions from country with country's cases, how country work during the pandemic on digital financial literacy and financial inclusion. But before all this, I would like to start by introducing, and I should say that this is my great honor and pleasure to introduce our great colleague and friend, Anna Maria Lusardi, Professor Lusardi. And Anna Maria is University Professor of Economics and Accountancy at the George Washington University. She is also founder of the Global Financial Literacy Excellence Center. And previously, she has a long academic career and successful academic career and a career of professor at universities such as Dartmouth College, Princeton University, University of Chicago Harris School of Public Policy, the University of Chicago Booth School of Business, and Columbia Business School. And she was also visiting scholar at Harvard Business School. So. It's a very impressive academic career, but what is also very important, and I believe it's especially important as we are in Roma here, that Anna also chairs, she's director of the Financial Education Committee in charge of designing the national strategy for financial literacy in Italy, so from the August of 2017. And I already know that now in Italy's month of financial literacy, and was delighted to participate yesterday in one of events with Anna on financial literacy. So I am sure Anna will say more about this financial literacy month. Besides of that, Anna also is chair of the research committee of the OECD International Network of Financial Education. So there are many other hats, let's say, and it's no surprise that Anna was included in the Forbes list of the 100 most successful women in Italy. So I'm very glad to give the floor to Anna, and yes. And I'm sure that Anna will give you visionary ideas on financial literacy and financial education and financial well-being in the world. And for all our online participants, just again to announce, to let you know that you can ask questions, so please use chat. You can write questions. We will have answers. We will have the questions and answers at the end of the session when all speakers will finish their presentations. So Anna, again, with great pleasure, the floor is yours.
Thank you very much, Anna. Thank you, Anna and Magda, for inviting me. It's a pleasure to attend the G20 Global Partnership for Financial Inclusion. Good afternoon, good evening, good morning to all of you and to those who are following online. As Anna said, I'm here in this double role, both as an academic and founder of the Global Financial Literacy Excellence Center in Washington, D.C., which is a center dedicated to financial literacy, but also as director of the Italian Financial Education Committee, in charge of designing and implementing a national strategy for financial literacy in Italy. Rarely do academics have an opportunity to do policy work. It's humbling to do so, in particular during difficult times like the ones we have been experiencing. And one of the things I would like to highlight in this short speech is the urgent need to address household financial vulnerabilities, both new and old. Last year, the Financial Education Committee, in collaboration with the data collection company Doxa, collected data on the financial situation of Italian families. And we did so because we want our work to always be driven by data and research. And I want to highlight three main findings from the data that speaks of the many vulnerabilities of Italian families. First of all, and importantly, many Italian families were already vulnerable before the pandemic, and it's important to address that and show that. For example, more than 40% of Italian families said that their income would not be enough to make ends meet. So their income would not be enough in a time of, in a sense, not crisis, but in a time of normal. Second, we found that the effect of the pandemic were quite unequally distributed in the population, just to echo what Minister Franco said. And two groups that were particularly hit hard by the pandemic were women and the young. And these are important groups in society as we look to the future. And third, financial literacy acted as a shield. It provided some protection against being hit hard by the pandemic. I always say that sailing or navigation lessons show their worth when you have to navigate a storm. Well, so is the case for financial knowledge. During the crisis, we could benefit the advantage of being financially literate and the importance of having basic financial knowledge not only in good times, but in particular in bad times. Another data corroborate this finding in Italy. In collaboration with the TIA Institute in the US, since 2017, we have been collecting data every year on what we have called the TIA Institute GFLEC Personal Finance Index, or PFIN in short, which measure knowledge and understanding, which enable sound financial decision-making and effective management of personal finances. So the PFIN index relates to common financial situations that individuals encounter, and in that sense, it can be viewed as a gauge of working knowledge. One advantage of collecting data at a yearly frequency is that one can assess findings before and after a big event. And I have to say, we did not have to wait too long for a major event to happen. Well, in January 2020, at a time when the stock market in the US was still roaring and the unemployment was at an all-time low, close to 30% of American families in the US would not have been able to face an unexpected expense of $2,000. So yet again, we find that families were vulnerable even before a financial crisis and at a time of economic expansion. We should remember that economic expansion do not lift all boats. And the long lines at the food bank we saw right after the pandemic started are a reminder of how painful crises are and how important it is to build financial resilience. Yet again, in the US as well, we found that women were particularly fragile. Many have talked about women yesterday, and I want to remind you that even in the context of developing countries, women are a vulnerable group, and more so during a pandemic. And even though the data collection has not been long, we started in 2017 and we are only at the 5th wave, we have reported a gender gap not only in financial resilience, but also in financial literacy. In the US, as in many countries around the world, unfortunately, women know less than men when it comes to finance. And what we see over this short time period is that these disparities are growing rather than closing. Those who are improving their financial knowledge are those who had higher financial knowledge to start with. So it's men and higher income respondents which actually are improving their financial literacy over time, thus this gender gap is growing. This finding stands well below Italy and the US. Together with collaborators from Bruegel, we also look at the financial fragility of European households. This time we use data from the European Union statistics on income and living condition. And the information available there is whether households could afford an unexpected required expense equal to about a month of income and pay that expense through their own resources. So yet again, we are seeing whether people could face a shock having and relying on their own resources. The data refers to 2018, which is a period of moderate growth in many European countries. So this time, looking at data from 27 countries, we find that 1 in 3 European households is unable to meet an unexpected shock during regular time, let alone during a pandemic. So the message from the data, I think, is clear. Going forward, we need to promote financial resilience. It should become a policy objective, not only because no one should be left behind, but also because it is more expensive to support families when a shock hits than to help them build financial security both in the short term and the long term. For example, we have many policies in place to promote retirement savings, but not to promote precautionary savings. But both policies are important. And one way to promote financial security is also to foster financial literacy. This year, we went back to interview the same Italian families that were contacted last year. So in other words, we have panel data on the financial situation of Italian families. And while there is evidence that the financial situation of many families in Italy is improving, thanks also to the swift response of the government, and I have to say thank you to the Minister Franco for the important work of the Ministry of Finance and the Economy, inequality have also widened. And if we have to give a face to financial vulnerability, to remind you that behind the numbers there are people, the face would be the one of a woman, a young person, someone living in the South, someone with low financial literacy. The data also shows that Italians had to resort to using technology, both for doing transactions and for other personal finance decisions. There has clearly been an increase in digital activities all over the world. And here I want to echo what Raghu Rajan called yesterday the opportunities and dangers of technology. Even though these activities tend to be underreported, several families in Italy, in fact 5%, admitted that they were victims of scams. Another 5% admitted to improper use of their data. And 23% stated they believe in financial news that turn out to be fake. And again, this is, I think, another feature of lack of financial resilience. And I want to add a note of caution about the use of technology. Let me return to the PFIN index data. Each year, we oversample a demographic group that we study in detail. In 2018, we oversampled the millennials, and we studied their use of technology. Surprisingly, those using technology, for example, to make payment, which is a common use of technology among the young, had worse financial outcomes. For example, they were more likely to overdraw their checking account and more likely to borrow at highest cost. Perhaps if you make it easy to pay, people will spend more. Well, surprisingly, even those who use technology to manage personal finances, such as keeping track of expenses, had worse financial outcome. So while technology can be very sophisticated, its use is not. We cannot assume that technology is simple enough that we don't have to teach about it. Promoting digital literacy is necessary and important, as it is clear here to stay. And we do find that people who are more financially literate use technology better, meaning they do not have those worse financial outcomes. In other words, technology and financial literacy are complement rather than substitute. Let me now conclude. I always say that the crisis gives us an opportunity to reimagine the future. And we cannot go back to the normal before the pandemic, because that normal was not good enough. It is time to focus on strengthening financial resilience and financial well-being for all. And one additional reason, while I'm here in Rome in October, it's because it is Financial Literacy Month in Italy. And following the recommendation of the data, we have dedicated this month to two of those vulnerable groups in Italy, women and the young. And the reason why I'm wearing this pin, which is actually our signature for the month, is to invite everybody, all the non-for-profit organization, institution, to join us in this effort to raise awareness toward the importance of improving financial literacy and also fight financial vulnerability. If we want to achieve an inclusive and robust recovery, we need to invest in these groups, not just because no one should be left behind, but also because building financial resilience will pay off. We do need a transformation, as the title of this session says, and it starts by taking a long-term approach and focusing on the needs of family, particularly the most vulnerable one. To paraphrase the words of a visionary and bold leader, we should do whatever it takes to put family on a path to financial security. Thank you very much.
Thank you very much, Anna. Thank you for this, as I say, visionary intervention, and especially as you said that the gap in financial literacy between men and women even continue to grow. It impressed me a lot, and being a mother of a young woman, actually, so I see that we really need to do more to equip our younger generation with financial literacy competences, financial literacy skills. And you described very well the need for the long-term approach and the importance of data, of evidence on the level of financial resilience is very low even in developed countries, which also actually Governor Visca also said yesterday about it, that it's the problem, the issue not only for developing world, but there is inequality in developed world too. But to give more data, and especially new data on the level of financial literacy and financial resilience globally, internationally, let's say, I would like to give the floor to our next speaker, also our distinguished speaker, not the guest speaker, the implementing partner of the GP5, Florent Msmes. Florent Msmes is acting deputy director of the OECD Directorate for Financial and Enterprise Affairs, and for many years executive secretary of the OECD International Network of Financial Education, which I also have the honor to be part of. And Florent is responsible for many OECD streams in financial affairs, but I think that one is, I am sure, the closest to her heart is financial literacy. So she joined the OECD in June 2000, and from that time developed a lot of activities in financial literacy and other fields. So, Florent, I think that with these words, I can give floor to you, and just to remind that 15 minutes, and I will show you the sign when it's 1 minute left. Thank you.
Thank you very much, Anna, and thank you, Magda and Anna, for the invitation. I have to say, it's always a pleasure to speak after Anna Maria Lusardi, although a bit impressive, so I'll try to do my best. And I'd like to say good morning, good evening to those online. It's good also. I would like to congratulate the Italian presidency for trying this hybrid meeting. I know it's challenging, so let's see if technology is working now. As mentioned by Anna, I will try and do my best in 15 minutes to present two of the reports that the OECD prepared for the GPFI and for the G20 Italian presidency this year, focusing obviously on digital financial literacy of individuals and also micro and small entrepreneurs. And Anna-Maria Lusardi focused a lot on household. I will do as well, but I will also share some fresh data on micro and small enterprises that was just released. I believe at least GPFI colleagues received the report this morning. So let me see if my slides are working. Yes, it works, fantastic. I don't need to spend a lot of time, I guess, on the background. Obviously, the COVID crisis was a financial shock, and it really tested the financial resilience of both individuals, households, and micro-entrepreneurs, obviously. And we've seen an acceleration of digitalization in terms of the provision of financial services, but also activities related to payments, sales, and business operation for micro and small entrepreneurs, as well as, and will be the focus of one of the report, the digital delivery of financial awareness, information, and education. So these are the two reports, and obviously I will only be able to share the highlights of those two reports. So please have a look if you're interested, especially if you want to look more into the data and the very rich data and examples that are provided in these two reports. So in a nutshell, my presentation will look at how the COVID pandemic affected the resilience of household and MSMEs. So that will be the first part where I will focus really on the data. Second, how did financial literacy and digitalization help or not MSMEs navigate the storm? So this will really focus on the orange report that you see now on the screen or on your computer, actually. And the last part will focus on the digital delivery of financial education to support financial resilience and transformation for individuals and micro and small entrepreneurs. So let me dig in a little bit. Just to add at the beginning that obviously this work is building first on the input of G20 and non-G20 countries to the first report. So thank you very much for providing us with all your examples. It was really useful. It's also building on a specific data collection exercise that we conducted in 14 countries, so 9 G20 countries and another set of 5 non-G20 countries into the financial literacy of MSME. But it's also building on, obviously, on ongoing work by the OECD and its International Network on Financial Education, this recommendation on financial literacy, but more importantly, perhaps for this presentation, a report on digital delivery of financial education. And at the bottom of the slide, you see the methodology on which we are basing the data collection for the adult population and MSME. So as I mentioned at the beginning, I will focus the first part of this presentation really at looking at how the COVID pandemic affects the financial resilience of households and MSMEs. Some of the data on household are really echoing what Anna-Maria Lusardi just mentioned, in a sense, and this is data that was collected prior to the pandemic. We are seeing a quite low level of financial resilience of adults and households before the pandemic, and here you have comparable data. Perhaps if you look at the bottom of the slides, we are looking at how long will household kind of live if they have a major source of income that is lost. And you see that around 1 in 3 couldn't live more than 1 month. So it means typically that there is not enough buffer, there's no precautionary saving in actually 1 in 3 households or individuals. And here the survey is collecting information in 26 countries. So it's very, I would say, consistent with the findings that Anna-Maria was sharing just a while ago. And again, insisting on the fact that this data has been collected prior to the pandemic. We are currently conducting some survey now, so we believe that we will see actually that household financial resilience is even lower now after the pandemic. And obviously, the pandemic has tested the financial resilience with income decline or losses. In many countries, of course, less savings, or actually households had to use savings to live. In some countries, Still, I have to mention that there was additional precautionary saving, but perhaps for the wealthy part of the population, deferring payments and debt repayments, seeking government support. Here I want to flag again, and again echoing Anna Maria Lusardi's comment, that some part of the population were particularly affected. And most of the time, these were populations that were already in difficult situation, low income, but also women, youth, and of course, because this is one of the focus of our report, MSMEs as well have been tested. We also see that, of course, there are variations according to the sector of the economy. Here, focusing on MSME, obviously, the COVID crisis had negative economic impact on MSME. Here on the left-hand side of the slide, you see that around 50% of especially small micro-entrepreneurs had a lack of liquidity. 60% actually mentioned that there was a negative impact of the crisis. No surprises there, just the data confirming what we believe. And of course, the crisis has been more severe for smaller micro and small entrepreneurs, more severe for female-headed micro-entrepreneurs, and I will come back on the gender issue in a minute, and more severe as well in some particular sector, accommodation, food and beverage, personal services, as well as construction. I know this slide is very busy, I apologize. The main message here is that the general context in terms of level of financial literacy, and by financial literacy I mean level of financial knowledge, behavior and attitude, is generally low for adults and MSMEs. So you see adults on the left-hand side, MSMEs on the right-hand side. Obviously, the data is not fully comparable because the data were not collected at the same time. What is interesting to see is that overall, our score of 100 is really assessing basic financial literacy, and neither adult nor MSME are actually reaching this very basic level of financial literacy. You just see that micro-entrepreneurs are doing slightly better, especially if they are slightly bigger businesses, let's put it this way, but still there is large room for improvement, and so when we see this issue around resilience, it is even more worrying. So the second part, and I'll try to be quick because I will present again to the GPFI tomorrow the finding on the MSME report, but since it is really fresh data, I just wanted to spend a little time on this particular report. So here we see that one of the consequences of the pandemic crisis has been that micro and small entrepreneurs have been stepping up their digitalization with an increase in digital activity in actually most of the micro and small entrepreneurs, and you see that perhaps the digitalization has stepped up even more in slightly larger businesses, 10 to 49 people. Here, an interesting finding of this new report is that financial literacy is really associated with positive business outcome. This is a finding that obviously we've not been able to prove in the past, so this is a very important finding of this report. Suddenly we see that micro and smaller entrepreneurs at a higher level of financial literacy had less negative impact from the crisis in a large number of countries that were surveyed. At the same time, again, micro and small entrepreneurs owners that had higher level of financial literacy had greater awareness of governmental support and actually lower need because perhaps their business was in a better condition. And last but not least, and perhaps the most striking and important finding here, is that micro and small entrepreneurs at a higher level of financial literacy were twice more likely to actually get access to credit. So it means, in terms of their relationship with the banks, perhaps they were really better prepared. So I think here a very interesting finding and something that really shows how important financial literacy is, including for small businesses. Gender difference, I don't want to spend too much time, but I hope that we can spend some time at the end of the session during the Q&A. So what I want to say is that the story on gender is not necessarily a straightforward one. I'd like to speak about gender differences rather than gender gaps. Clearly, financial knowledge is lower for women rather than men, but we also see the fact that in no country female MSME owners have higher level of financial literacy than men. So There are gender differences that are always against women and never in their favor in no country. At the same time, financial resilience of women is lower than that of men, and it goes for adult population, but also for female-headed MSMEs. Anna tells me that I have very little time, so just to say that the first report that you saw on the slide is really focusing on the digital delivery of financial education. The pros and cons of digital tools have been mentioned many times. When it comes to delivering financial education, it is the same. I will not go into the detail, but obviously we see many pluses, but at the same time many challenges that needs to be overcome. I'd like to flag just the last one on the slide. Obviously, getting more data is really helping us making sure that financial education is more relevant, and in a sense it also helps us evaluating the programs more easily. But at the same time, there is this issue around personal data protection that should not be ignored and that should be addressed well. I'm going to skip that slide. This slide is really showing the experience of many countries developing digital delivery of financial education in a very smart way. You can look at the report if you're interested in getting into those examples. Some ways also to overcome the fact that sometimes digital access and skills and using simple technology, for example, or hybrid delivery can be considered. And the report actually the blue report, shall I call it, is handing with effective approaches which are really fitting into the menu of policy options that was mentioned at the beginning of the session and yesterday by Magda. I don't want to dwell on that, just to say that we do believe, like Anna Maria just said, that indeed this crisis is a teachable moment, but that we should make more of it. So we shouldn't really focus on the short term, but very much on the long term to build strategy that will ultimately support financial well-being for individuals and micro-entrepreneurs. And of course, digitalization is one of the tools that can be used for that. Just to say, and to end, don't worry, Anna, I'm finished. As you know, we've just released this report on digital financial literacy of MSME. 14 countries have participated, and I would like to thank them very much. I have to say that we have actually many countries that have participated in this exercise today in the room, so I would like to thank them. We are eager actually to extend this data collection, so if more countries would like to use the tool, we are very happy to get in touch with those countries and to extend the data set and potentially the analysis. We want to continue to implement, of course, our policy recommendation on financial literacy, and we are doing that in a number of countries thanks to the support of, for example, the Ministry of Finance of the Russian Federation in Eurasia, in Southeastern Europe. I'd like to mention the support of the Netherlands here and many others. Last but not least, we are quite keen to continue to work on new trends, and especially we're speaking of the recovery. So we are working a lot on integrating digitalization and sustainability into financial literacy competencies, and this is a project that is ongoing with the European Commission. I'll stop here, and I hope that there will be enough time for question and answer. Sorry if I've been a bit long. I had a lot to cover.
Thank you very much, Florence. Thank you for this very deep analysis and presentation of new data and previous data. And now we will move to three country cases. I would like just to move straight to the three country cases, that then we have more time for discussion and questions and answers. And again, I would like to remind that you can put your questions to the chat, and of course those who are in audience can just raise hands after the presentations. And first, we have some speakers with slides, some without slides. So first, participants of this panel discussion is James Woodson. James is an economist in the US Department of the Treasury. And James, I hope you're already with us, connected, and I would like to give the floor to you. And Anna Maria already gave you examples of the financial resilience and sometimes low-level financial resilience of US citizens, but at the same time we know how much is done in financial literacy field in the US. So would you like to comment and say what is situation, what is the impact of pandemic on the financial resilience resilience and digital financial literacy of the population, and what are measures that Treasury and government do in order to protect and help people?
Yes, thank you, Anna. Can everyone hear me?
James, not really well. We can hear you. If you can make it louder.
Excellent. Sure. So yes, so
No, so sorry, James, we still can't hear you. I don't know how it's sound for those who online, but for us here, it's not loud at all. I can hear you, but very, very low sound. Can you, colleagues, can you help us?
sure. How is this?
It must
Just
be
a
problem
moment,
there
our
in the
tech
room, but
colleagues help.
online we can hear fine. Just a second, please.
Can you try again, speak, please?
Yes, can you try again?
Yes, hi. How is that?
Yes, it's much better, I think. Right?
Excellent. Okay.
Great. Now it's great.
Perfect. Thank you, Anna, and thank you to the Italian G20 presidency and to the GPFI for organizing this excellent symposium. So as Anna mentioned, I work on international financial inclusion issues for U.S. Treasury, and I'm currently a U.S. delegate to the GPFI. But today I'm going to briefly discuss the work my U.S. colleagues are doing domestically around financial literacy, both generally and in response to the pandemic. So we understand the importance of effective financial literacy can have in helping people navigate their personal finances. As Secretary Yellen has noted, financial literacy can have a lasting positive impact on people's lives, and it can be part of our strategy to build a more equitable economy. The U.S. federal government's financial literacy efforts are coordinated by the Financial Literacy and Education Commission, also known as FLEC, which was established by law in 2003. The commission is made up of the heads of more than 20 federal agencies, and it is chaired by the Secretary of the Treasury and coordinated by Treasury's Office of Consumer Policy. The commission's vision is for sustained financial well-being for all individuals and families in the U.S. In furtherance of this vision, the commission sets strategic direction for policy, education, practice, research, and coordination so that all Americans can make more informed financial decisions. The commission maintains a national financial education website, mymoney.gov, and has issued 3 national strategies on financial education since its creation. In 2020, the commission released the U.S. National Strategy for Financial Literacy 2020. This strategy seeks to improve financial literacy and education among Americans by providing evidence-based best practices to the financial education field, which are relevant to helping consumers navigate both traditional and digital financial services. Use of these best practices can help improve the delivery of financial education on different topics, especially for diverse populations, including historically underserved groups. So I will very briefly summarize these best practices, which include, number 1, know the individuals and families to be served. So financial education and delivery methods must be tailored to the circumstances and needs of the individual. 2, provide actionable, relevant, and timely information, which results in greater likelihood of retention and action. 3, improve key financial skills rather than transmitting knowledge of particular facts about financial products and services. 4, build on motivation. And 5, make it easy to make good decisions and follow through. So for example, changing the options presented and removing hassles and barriers can help people bridge the gap between intentions and actions. The financial education field should also develop standards for professional educators and provide ongoing support to consumers. And finally, number 7, evaluate for impact and develop a culture of continuous improvement. So with respect to the digital delivery of financial education, the 2020 strategy articulates that FLEC agencies and the financial education field must consider the quickly evolving technology landscape as they develop strategies to improve financial financial decision-making. And currently, several FLEC agencies deploy technology-based approaches, such as the CFPB's online training program, Misadventures in Money Management, which uses an interactive, game-like virtual environment to build financial knowledge. During the COVID-19 emergency, FLEC agencies responded by providing valuable information and tools on a range of topics, including information on accessing benefits, understanding mortgage forbearance and student loan relief, weathering volatile markets for investments, and avoiding frauds and scams. FLEC agencies, led by the Department of Treasury, worked to quickly and effectively implement the Coronavirus Aid, Relief, and Economic Security Act enacted in 2020. Treasury's efforts included issuing over $270 billion of economic impact payments to over 160 million families. And Treasury coordinated closely with several FLEC agencies to help inform Americans about how to receive these payments quickly and safely. In addition to this financial assistance, FLEC agencies provided information to Americans on a range of critical financial topics. Many of these were targeted to financially vulnerable populations and were made available in multiple languages. So to conclude, we understand that financial literacy and financial inclusion are interlinked. As Secretary Yellen has said, quote, when we talk about financial inclusion, people tend to think about connecting people with bank accounts, for instance, and that's important. But many people also need more than a door to financial services. They need guidance in using them, help to overcome financial setbacks, tools to manage their daily needs, and support to take steps toward a brighter future. Any push for financial inclusion must include quality financial education too, end quote. And with that, I'll leave it there. Thank you.
Thank you very much, James. Thank you for your case, US case. And now we will move to another country, Brazil. And I would like to give the floor to Diogo Cruz from the Central Bank of Brazil. Diogo works for the Financial Citizenship Department at the Central Bank of Brazil. And please put the slides. Diogo, just to remind that just 5 minutes maximum.
Okay, thank you, Anna. Can you hear me?
Yes, perfectly.
Okay, let me just share my slides. Can you see it?
Yes, if you can make it full screen. Yes, great.
Yes, okay. Just a second. Sorry. Okay, thank you. Good morning, good afternoon, good evening to all of you. As Anna said, my name is Diogo Cruz. I work for the Central Bank of Brazil. And now I'll present a bit of what's going on in Brazil about this theme. I'll present a few information here that is actually going to be on our financial citizenship report, soon to be published by the Central Bank of Brazil. So, we have seen a big transformation of the financial services landscape lately. I'll mention here a few highlights. The graph shows the increase in cell phone financial transactions over the last 6 years. As you can see, the increasing pattern on the gray line. In 2020, mainly as a consequence of the COVID-19 temporary emergency cash transfer program, we have identified the inclusion of 14 million low-income citizens into the financial system. Also in 2020, in November, the Central Bank of Brazil launched the new instant payment scheme, so-called PIX, that enabled users to digitally send or receive payment transfers in a few seconds at any time, including on business days. So PIX was quickly adopted by the population. We have already more than 100 million PIX users, which includes low-income citizens and MSMEs. And what's really interesting is that just a few months after PIX was implemented by March, already 17 million PIX users were not users of other digital money transfer scheme the year before PIX. So this is an example of a huge inclusion in terms of digital payments. When we consider vulnerable population, realize that digital access still lags compared to the overall population. We have seen an improvement in terms of gap reduction. I have two graphs to show you regarding elder population. As you can see, the population aging more than 60 years old, the blue line, the first graph, are catching up in terms of the use of internet. We do acknowledge that there's still a long way to go. In terms of PICs, on the second graph, there's still gap with the younger, when you compare with the younger population, but they're also progressively adopting the new instant payment scheme. This data, for instance, is from March, just the first few months of PICs. The same pattern we can see when we talk about income. Income gap in terms of access to internet is decreasing, even though it still exists. Lower income brackets are represented by the yellow line in the first graph. So also similar pattern with the PICs, with the use of PICs, where the blue bar shows the beneficiaries of social programs as comparison to the green dots, which are the rest of the adult population. When talking about financial resilience, I would like to briefly mention the Brazilian Financial Health Indicator that was prepared under an agreement between the Central Bank of Brazil and the Brazilian Federation of Banks. The indicator's questionnaire included a specific item of self-reported resilience, and that's the assessment we bring here, using this indicator as a way to assess the most vulnerable groups and address their specific needs. So in the first analysis, we identified these three groups on the slide, being more likely to be less resilient. So women being more likely than men for being less resilient, being older also related to an increase in vulnerability, and income as the most strong factor influencing the chances of being resilient. So when thinking of these three groups, we see the digital provision of financial services and financial education as an opportunity to transform the financial realities of Brazilians in terms of inclusion and resilience. Talking specifically about digital financial literacy, having considered the new landscape and financial resilience, we have in mind that in terms of how things are shared, we think of digital financial literacy as an opportunity the digital world allows to expand populations targeted by our financial education programs. As an example, with an online-based platform, we were able to reach a large community of teachers and school heads with our training for a financial literacy program for elementary schools. That would have cost a lot more time and resources otherwise. In terms of who it reaches, we have to take into account those digitally excluded. We believe digital literacy has to be part of our concerns when considering financial inclusion. And we think a good way to go, for example, to make digital financial literacy tools also accessible by choosing very simple technologies. We also believe the content should be updated for this new reality we have. So financial education has to encompass digital transformation of the financial systems as a whole. In Brazil, for instance, it's no longer possible to talk about payments without mentioning PIX transactions through the mobile phone. We believe digital delivery offers an opportunity in terms of ability to adapt to different needs and preferences. This will be the case, for instance, of the Meu Bolso em Dia platform, developed under the same agreement with the Banks Federation. It uses the Brazilian Financial Health Indicator to assess users' financial education needs and direct them to suitable learning tracks and easy-to-use tools. So that was it. Thank you, Anna. The floor is yours. And can you please unshare my screen, anyone? Just having trouble with the Italian
Yes,
language here.
thank you very much, Diogo. Thank you for your examples, and what we see that it also correlates very well with what was said already and results in the OECD research, and what Anna Maria said, that financial literacy is really instrumental in improving financial resilience for older people, for younger people, and help to assist in gender gap. We have one more speaker from India. Our next speaker is Pawan Kumar, is working as Director of Investment and Digital Economy Department of Economic Affairs in Ministry of Finance. Pawan Kumar, the floor is yours, and please also remember 5 minutes maximum.
Thank you, Anna. Thanks for giving us this opportunity. This is the 75th year of India's independence that we are celebrating this year, and a couple of thoughts very quickly. I'll run past. Next. So our learning for financial inclusion, when we talk, what we say that welfare for all through upliftment of the weakest, that's our motto of the financial inclusion. And what we have discovered is that large-scale social problems that requires unbundling of the problems, and then creation of shared digital infrastructure as a public good, and on top of which the innovative solutions can be assembled to meet diverse contextual needs. And that has been our motto. Next. And yes, a lot of you are already aware. I will not waste too much of time, but this is our acceleration of financial inclusion via India stack. That is the three models, that is identity layer, payment layer, and the consent layer. Next. We have a digital biometric system, which is now the world's largest biometric identification system for individuals, whether financially excluded, included, literate, illiterate, so it covers all. And that is where our basis for financial inclusion and financial literacy starts. Next. We have our own system, which is UPI, which is the fastest growing digital payment globally. And then you see the numbers, which is in last 5-6 years now, more than 71 billion digital transactions only through this app, which is the instant retail payment app. This has been adopted very widely across the country. And not only this UPI as a payment system, but right now we are the country with highest digital transaction, more than 2 billion digital transactions per month noticing, and the numbers are rising very fast. Next. So what is this? Our first phase of financial inclusion that completed. Now we are into our second phase of this financial inclusion that starts with this account aggregator system for data sharing. And that is where the role of MSMEs comes, where we want to link MSMEs to our digital databases of the data that they create and their data that can be used by themselves. And our first use case that has started, where we have started linking these data through the account aggregator, wherein the data flows in a manner wherein it cannot be misused, and then for the access of loans and money management for all these MSMEs, including individuals and more vulnerable sections of the society. So the first use case has just started. Of course, over a period of time, we are now moving into open credit enablement network that will enable credit at a large scale using all the digital infrastructure, including the goods and services tax network, on which more than 10 million registered users are already based. Next. Of course, so there has been a lot of measures which has been taken now. So there is a dedicated portal for MSMEs wherein they have a comprehensive digital platform. And approximately right now is just started last year, and then 1 million registrations have already happened, and the number is growing very, very fast. Next. So digital financial literacy, of course, when I spoke about the unbundling of the large scale problem, when you make the financial society financially inclusive, at the same time, financial literacy is a big part. And there are various organizations, including our central bank, Reserve Bank of India, which has been very, very active in this space. But there are just a few of the initiatives that I listed. Next. So one of the infrastructure that we have at the village level, that is a common service center scheme, where this is a single point model, and which delivers government services in rural areas. Now we have more than 3.6 lakhs common service centers across the countries. And of course, it is pictorially presented that this is a center which provides multiple services at multiple transaction points. Next. For literacy, we have a special scheme which is
One minute.
Yeah. So just a minute, I'll finish. So this is the PM Digital Saksharta Abhiyan, and of course that there is a massive push for covering more than 60 million people personnel in rural areas to be digitally literate, and there are many other schemes which are operating. Next. So we have this national strategy for financial inclusion as well as National Center for Financial Education. So both are working very well, and of course this part of this strategy is very well covered. And of course, when the report will come out, these are all parts of the report. Next. So National Center of Financial, next. So digital infrastructure coupled with digital literacy has led India out of the pandemic. Now this has been shown in the financial, through the financial resilience that has been shown by our MSMEs. Next. And this is the new, using the same infrastructure, just wanted to bring this, that using the same philosophy that we have for financial inclusion, now our Ayushman Bharat Digital Mission has been launched, which is creating a health ID for every citizen. And this will create an ecosystem just like what we have done in the space of the payment system. Now what we call it as a health stack, which will create health for all. And of course, there is more similar models are going to be replicated. Next. Thank you.
Thank you. Thank you very much, Pawan. I was going to say that, yes, I'm sorry, it's all really interesting. We're just a bit running out of time, so that's why I have this difficult mission to stop speakers, though I would like to listen more. We have a short time for the questions and answers while we are looking if there are any online questions. Probably we have, if we have questions, yes? We have, if you have questions here in the audience, please raise your hand. Because I actually, if not yet, while you think about that, I have brief questions. I hope for brief answers to both speakers, to Florent Messi and Anna-Marie Lusardi. And first, Florent, you mentioned that it's better to say even not gap, but difference in men and women financial literacy, and especially, I believe, in new data on MSME. And you gave few examples, but could you elaborate a little bit on that? What do you mean by that? And in these terms, what would be what you see from this data report or from the OECD in fair experience would be the most effective ways to help women to improve their financial literacy, financial resilience, both as entrepreneurs, as just individuals. But very briefly, please. And then I will ask Anna.
Yeah, it's potentially, it's not a very short question and potentially complicated. What I mean, I prefer to use differences than gap, and I will explain you why, because I think the picture, first I don't, well, although I love data, I don't like average. So there may be women that are far better than men, and that goes for any groups, by the way. But in terms of women, we see that typically what Anna Maria is also finding, and was perhaps the first to find, is lower level of financial knowledge, lower level of financial confidence, and attitude is a bit problematic. But we see, for example, that women are quite good at day-to-day management. So that's an important. They are risk adverse, again, on average. And this can be positive in some sense, and in some others negative, especially when it comes to investment for the long term. So this is why I'm speaking of differences rather than gaps, because the picture is a bit patchy, and we can actually build on the strength of women, the fact that actually they know that they don't know, as Anna Maria found in her research, but also the fact that they are maybe risk adverse, and their attitude that is relatively positive to learning and opening. And the last finding on the MSME, I think what it reveals is the resilience and vulnerability of women. And this is really what it shows, that in terms of women that are micro-entrepreneurs, again, we're speaking on average here. I'm not saying that all women are necessarily in difficulty. They are relatively less resilient and less able to adapt to shocks. So that's the main issue here, and perhaps the risk adversity is not helping. So in terms of policymakers, I think no one size fits all. Every country has different culture, and we need to take into account not only the gaps in knowledge and confidence, but also the legal structure of the country. So that's first. But then I would really focus on the weaknesses and on groups of women that are particularly in difficulty. I want to end my little intervention on women on saying that it is very important to make sure that women have enough for their own future. And here I'm thinking about saving for themselves and for their future. Women are lucky enough to live quite often longer than men, but they are quite often fewer resources, and this crisis really showed that. So I hope I try to address some of the points you raised. But I think what policymakers need is more granular data on gender, and we are still struggling with that. And second, address really the needs of specific group of women that are really in difficulties.
Thank you very much, Floran. And Anna, if you would like to comment on this part, that's also would be good. But also, I would like to ask you about one particular thing, because you mentioned and you have this paper on the level of confidence of women. And Floran just mentioned that this is one of the key issues, and we have the same results in Russia that really, yes, women are better in day-to-day financial management, but they do not save for a longer term. They do not invest for a longer term, and they have less confidence in this question. So what you would, as a researcher from one side and now as part of policy, making committee, what you would recommend, what would help in this?
Thank you very much, Anna. I just want to explain a little bit some of the findings. So, for example, when you look at the financial literacy, and I'm going to use the word differences from now on, I think it's a very good way to picture it. The reason why women are less likely to be measured as less financially literate is not because they are wrong on financial literacy questions, but because they tend to disproportionately answer with, I do not know. And so women, when they are not 100% sure, they actually don't attempt to answer. And I see this in my classroom as well. So, what we see, in a sense, in this difference in financial literacy between women and men is both confidence, not being 100% sure, and knowledge. And I think that's important as we do policy. Policy, in a sense, I think should be take this finding into account, and for example, I think do programs which are more targeted to women, so where you foster not just knowledge but also confidence. And one other ways would be, we have seen, for example, that women working in group might build that confidence more. So it's not perhaps surprising that there are several groups in the US, for example, investment clubs, and they are disproportionately composed of women. So, women might work well together, and that might be another way to do so. But I do think that the most effective way, to address the gender gap is to have financial literacy in school. And Italy, unfortunately, is one of the few countries where the gender difference in financial literacy starts even in high school. So I think if we provide wide access to everybody, that might be one way in which we stop these gender differences from starting, and maybe the knowledge acquired at school can spill over to the family as well.
Thank you very much. And as continuation, I think, of this discussion, we got question from Sean Parkinson, UK. A question to our panelists. Could you provide examples on how your country's financial literacy programs are being tailored to women and how you're collecting information on women's needs? So it's a question to Pawan Kumar and Jim and Diogo. But please also try to be very, very brief, just a few examples, one example each.
So my RBI colleague, would you like to respond?
Sorry? Yes,
Okay.
you can say just provide a few examples on how your country's financial literacy programs are being targeted on women, how you learn their needs and how you target the programs on women needs. Exactly what Anna-Marie suggested right now.
Okay.
If you
I'll just quickly respond. So basically, as part of this National Strategy for Financial Education, as well as National Strategy for Financial Literacy, so there are certain targets which are there, which has been kept in mind. And this is, as per the documentation, this is for all, across all the departments that they have to adhere to. And then there is a vision set for next few years, that is by 2020-22, what we need to do. For example, opening a bank accounts, reaching to every adult, making so many people literate. And these are the targets by which everything is measured. In terms of overall collection, that there are certain exercises on gender budgeting also which are conducted. And there are various tools by which these informations are being collected. Of course, because of the shortage of time, perhaps I will not go in much into detail.
Okay, thank you very much. And Diego, James, would you like to answer also this question? If you have any examples of that.
Sure, I can go very briefly. Please.
No, just go ahead, Joe. It's okay.
Okay. So, as I mentioned, there are over 20 federal agencies that are involved in various aspects of financial literacy and financial consumer education. The efforts are summarized in an annual report by the Financial Literacy and Education Commission, which I will post a link to in the chat. There's a research being undertaken by various agencies, including the CFPB, and I will also post links to that as well. Thank you.
Thank you, James. Diego?
Okay, just very quickly, we had in the past a program specifically for women social beneficiaries, which are mainly women, but right now, in our programs, we don't have something specific tailored to in terms of gender, but we do acknowledge the importance of that.
Okay, so thank you very much. A question? Yes, please.
I come in from Reserve Bank of India here.
Yes, we hear you perfectly, please. Please go ahead.
Initiatives we have taken in India as regarding financial literacy specifically for women. So we have come out with a second iteration of the National Strategy for Financial Education, the NSFE, that is for a period of 5 years from 2020 to 25. So women are identified as a specific target group under the strategy. And we have developed specific content for the women, specifically designated for the women. And we also have the project called Center for Financial Literacy Project. So this is a project at the grassroots level. It is a collaboration between non-governmental organizations, the NGOs, and the banks with funding from a fund of the RBI. So this targets financial literacy interventions at the very base level, at the block level. And here women are identified as a target group, and we are trying to design interventions keeping them in mind and keeping their requirements in mind. So based on their requirement, at what time we can go and meet them, and what are the specific interventions they require. So based on those requirements, we have designed, this was a pilot project in certain specified identified areas. Now we are scaling it up across the entire country. Thank you.
Thank you very much. I think we are finishing now. Thank you very much to all speakers, all panelists. I think that this discussion and data presented at this session just show again, and I would like to stress that this is a very important momentum right now, and we need to work further based on this situation to improve financial literacy and financial resilience, as we see that women and young people and MSME and some other vulnerable group or underserved group are very important. And I think that it's also very important to look, as we discuss about women, for example, not only as like vulnerable group, but this is the half of population of the world, and this is the economic empowerment of women through financial inclusion and financial literacy really helps to make the global, the world more prosper and more wealthy and more resilient, and families, of course, at the end of the day. So I believe that this longer-term approach is really important, and of course, as GP5 co-chairs will continue to do so. And just to say that reports which were briefly presented at this session by Floran, they will be, of course, published published. They will be released after they would be approved at the Finance Minister Central Bank Governors meeting on 13th of October. So all reports, all we mentioned during these 2 days of symposium will be at our gpfi.org website. So just to let you know that you will get more rich data and information there. And by saying that, again, thank you very much, and I give floor back to Magda.
Thank you, Anna. That was a very exciting session. So now we can move to our third session on financial consumer and Msmes protection. What have we learned? What have we done during COVID? What can we use to leap forward now? Before we start, we do the same now, so start thinking about your questions. You can put them on the chat, and we will use them at the end of the session. Hence now, I'm really pleased and honored to give the floor for an introductory speech to Professor Jonathan Zinman from Dartmouth College. We had actually hoped that he would join us here in Rome, but unfortunately, in the end, it was not possible this time. Professor Zinman is really the right person to guide us in this discussion. As I said, he is Stephen Chehill Professor of Economics at Dartmouth College. He is co-founder of Dartmouth Household Finance Seminar. His research focuses on household finance and behavioral economics. But what is interesting for us, I think, is that Professor Zinman also applies his research by working with policymakers and practitioners around the globe. He has served on the Consumer Advisory Board of the Consumer Financial Protection Bureau in the US, as an advisor to the Federal Reserve Board, the Federal Reserve Bank of Philadelphia, the Federal Reserve Bank of Boston. I think this mixture of very strong academic competencies, but also attention and involvement with policies, makes his contribution very important for us. So Professor Zinman, the floor is yours. Thank you.
Okay. Can you see?
Yes, perfect.
My slides okay? Do I need to swap the screen or?
Yes, please. Yes.
Let's see. Is that better?
Thank you.
Perfect. Yes, better.
Okay. Thank you so much. Greetings from the woods of New Hampshire, and thank you very much for inviting me to be one of your guest speakers. Hopefully you won't find me too impolite as a guest. And I do really wish that we were together in person. As you'll see from my brief remarks here, I do think there's a lot to talk about. We have a lot to talk about at a high level in terms of policy and policy development for consumer financial protection. So my charge here was to talk about coping with new and old vulnerabilities in the post-pandemic world. Like the incorrigible academic that I am reinterpreting my assignment a bit to talk more about vulnerabilities in developing and implementing effective consumer financial protection policy. What do I mean by that? Our various and distinguished speakers have raised, countless policy issues over the last day plus. To build a solid foundation for effective and just policymaking that address many of these issues, especially the thornier ones, the more complex ones, I'll talk about the importance of needing to understand the markets and consumers that we're regulating. I'll be talking a lot in the next few minutes about what we don't know, including many sort of basic assumptions we make that we don't understand as well as I think we all tend to think we understand. And then I'll close with some more helpful advice and opinions on what I think we do understand well and what is more actionable at a high level. So I'll start by talking about three, sort of very basic fundamental assumptions we often make in developing consumer financial protection policy, that we know how to diagnose a problem when we see one, that we know how to develop a high-level solution, that the state is an instrument, an effective and fair instrument of consumer protection. And I'll give some examples about how those assumptions are not generally correct, and that things are not as obvious as they may seem, unfortunately. And then, as I said, I'll close by with some thoughts on what we do know beyond a reasonable doubt, focused on some of the more contentious and complex approaches to consumer financial protection policy. So, clearly, when we are developing and implementing policy, we need to start by identifying and diagnosing a problem that we're trying to solve. A key and very complex problem that many speakers have mentioned regulating is over-indebtedness. I'm going to give you two brief examples that it's not actually easy to know over-indebtedness when we see one. It's not actually easy to formulate clear and sensible objectives for regulating debt levels and debt burdens for consumer financial protection purposes. So one common approach to diagnosing over-indebtedness relies on debt-to-income ratio cutoffs, right? So I apologize for using the abbreviation here on my slides. There are many conceptual and practical challenges with this approach. So how high is too high for a DTI, for a debt-to-income ratio? We don't know from the perspective of evidence-based policy, and moreover, conceptually and empirically speaking, there's probably a lot of heterogeneity across borrowers and market conditions in terms of what a sensible cutoff would be if there is going to be one. And moreover, still, those who tend to accumulate higher debt burdens, higher DTIs, may well have greater benefits from borrowing and being able to borrow more on the margin. In other words, the most vulnerable folks and SMEs who we're most interested in may have the greatest needs and most productive uses broadly defined for borrowing and borrowing more. There are also some practical challenges that I won't have time to get into with measuring debt. How exactly do we find debt? What's going to go into the numerator of this ratio? A second common approach to defining and trying to diagnose over-indebtedness relies on default rates. And a striking thing here from my perspective is that sometimes we diagnose over-indebtedness based on default rates being too low, and other times we diagnose over-indebtedness based on default rates being too high. In other words, we're, as a policy community, we're a bit schizophrenic in how we try to identify over-indebtedness based on default rates on loans. So what do I mean by this? Well, at the heart of the debt trap notion, which is sorry, I'm getting feedback from someone else's audio, I think. So at the heart of the debt trap notion, which is very much at the heart of concerns about a lot of expensive short-term borrowing, particularly in consumer credit markets. At the heart of this notion is that borrowers are borrowing repeatedly and refinancing or rolling over because they can't make balloon payments on short-term, expensive installment loans. Well, it's worth noting that the commercial paper market exhibits exactly this sort of pattern. I don't mean to be flip, but there's not a lot of thrust to shut down the commercial paper market because large issuers there borrow repeatedly from their lenders. Perhaps more to the point, borrowing repeatedly, even at very high cost, is not necessarily inefficient or harmful for borrowers, at least on the margin, if borrowers correctly forecast their borrowing. And with co-authors, I have a new paper that tackles just this issue. On the other hand, we sometimes diagnose over-indebtedness based on default rates being too high. You know, the mortgage crisis leading to the financial crisis is an example of this, at least in hindsight. I'm more sympathetic to this approach to diagnosis, but it has many practical issues, of course, and some conceptual issues as well. You know, when I teach intro finance to my students, the first thing I teach them is no risk, no reward. And so we certainly don't want default rates being too low, because that would suggest that lenders and borrowers are not taking enough risk. Moreover, the ability to default in tough times, whether tough macroeconomic times or idiosyncratically tough times for a household or a consumer, is a valuable option from a finance perspective. It provides insurance against various bad states of the world. And so we shouldn't necessarily leap to inferring that default is necessarily a bad thing, just as we wouldn't necessarily leap to inferring that someone filing a claim on their insurance policy is doing something destructive or harmful to themselves or to the economy. So another key assumption, and maybe this is something that has held more sway in my own country in the US, is that robust competition is the single best means for protecting consumer interests. And so this is an example of are we actually good at identifying high-level solutions to challenging policy and regulatory problems, or are things more complicated than they seem? At least three strands of work, in particular theoretical work in academic research right now, are casting doubt on the generality of this approach. And again, this is an approach that has long sort of been a fundamental underpinning to US consumer financial protection policy. A lot of our regulation is designed to promote and facilitate competition. Well, unfortunately, things are far more complicated than this. Behavioral industrial organization has been finding recently, at least theoretically, that when consumers make mistakes, and we're certainly worried about some consumers making mistakes, competition and other market-based solutions often do not help them and may even harm them, especially when competition is focused on what we refer to as add-ons, not base products. And so what's an example of an add-on? An add-on is a late fee to a loan. An add-on is a $40 overdraft fee to a checking account, as we still often see in the United States. Another complicating factor is that platform markets are different. Again, more competition does not always imply better outcomes for consumers when we have platform markets, and indeed, much of the digital is designed and delivered on platform markets, by which I mean multi-sided markets where there are network externalities and competition is even more difficult to define and measure than usual. And this is pertinent not just for payments markets in digital and digital financial conclusion, but also for marketplaces that are meant to facilitate consumer search. Finally, asymmetric information has long been a key underpinning to developing financial inclusion policy and interventions. dating back at least to microcredit. Again, when we have meaningful asymmetric information problems, it's not so simple that increasing competition, promoting competition is going to deliver better outcomes for consumers. And I'm really excited to report that work on this question has been revived recently with a couple important new papers on the academic side. Another example of a key assumption we often build policy on, but is not generally true, unfortunately, is that the state is a benevolent actor from the standpoint of those it is at least nominally seeking to protect, in this case, consumers, who are my focus. Yesterday, several of the speakers commented on challenges with surveillance and privacy. Moving beyond those, and again, focusing and critiquing my own country, the United States, I think it's relatively well understood, but sometimes forgotten, depending on the context, that consumer protections may be applied unequally. Regulators discriminate too, and of course, there are always concerns about regulatory capture and corruption. I think perhaps less widely appreciated is that financial inclusion, financial access, even to something as controversial as high-cost credit, may provide valuable protection against the state, against policies that make, for example, access to justice predicated on access to liquidity. So there's a very important strand of policy, practice, and research emerging, focusing on these questions. In the U.S., pretrial detention with cash bail is a big issue. If you are poor and awaiting trial, and the judge requires you to post bail to get out of jail while you were awaiting trial, having access to liquidity is very important to your life and your family's economic life. And in the U.S., at least, it goes beyond that, unfortunately, in the sense that there's very unequal access to legal services and legal representation. Again, money matters, liquidity matters, and moreover, the state itself, there's now compelling evidence, thanks to my junior colleague, Steve Mello, that the state itself sends vulnerable people into financial crisis and downward spirals by fining them for minor infractions like parking tickets and speeding tickets. Okay.
Jonathan, can I ask you whether you can have 2 more minutes? Thank you.
2 more minutes. 2 more minutes is perfect. Sorry. So what do we do with all this? What do we do with all this complexity and this humility that we should be bringing to the policy development process? I do think we know some things, even about contentious and complex policy issues. One is that restricting access to base products is likely welfare reducing. Policymakers seem to have this intuition for some products like bank accounts, but not for others. I believe it holds even for others like expensive credit, and we can talk more about this in the Q&A. Restricting supplier ability to charge high add-on prices, high fees for that are based on behavior like overdrafting, that's likely welfare enhancing. We probably should be restricting those high contingent fees. And I haven't had a chance to talk about restricting deceptive advertising, unfortunately. From the perspective of regulatory architecture, I think others have noticed that jurisdictional silos are inefficient, and this is becoming an emergent problem with the rise of non-bank players. A more novel point, maybe more U.S. focused perhaps, is should we not be applying fiduciary standards to products besides investment products, I don't see why not. And finally, evidence-based policy requires more than just data and monitoring. We need to understand what we're seeing. And that requires a granular understanding of consumer decision-making, of market functioning and malfunctioning, of what exactly we want to measure and how we should be measuring it. This is all the research and development. And my argument is that it's essential for formulating the accurate assumptions that provide the foundation for effective and fair evidence-based policy in the digital era and beyond. Thanks.
Thank you very much, Professor Zinman, for having somehow shaken some of our certainties by identifying also the fraud approaches, but that's very constructive. And we will certainly go on talking offline, but I think your final sentence about the importance of effective evidence-based policy is the most important one, and especially leads us to the next presentation, the presentation of the report that the OECD prepared for GPFI on the approaches on consumers and Msmes, mainly consumer protection across countries, somehow selecting those that looked most effective in supporting financial inclusion. Miles Larbe will present. Miles is an acting head of the Consumer Finance, Insurance and Pension divisions at the OECD. He is responsible for the work of OECD on international financial consumer protection policy and supporting the G20 OECD task force on financial consumer protection and FinConnect. I think this is enough for your introduction. Many other things could be said, but Miles, the floor is yours.
Thank you very much, Magda. Thank you, Anna. It's my pleasure today to present to you this third report produced by the OECD for the G20 GPFI this year. And I'd like to thank everybody for the engagement in the development of this report. It's been a real pleasure to work with you as we've produced this important piece of work. I'm going to go quite quickly because I know time is against us, but the final report I know was circulated to everybody this morning, and as you can see on this slide, which recaps the scope and the process, we've developed it obviously in close consultation with all of you and with members of the G20 OECD Task Force on Financial Consumer Protection, with 3 rounds of review and consultation. And thank you again for all of the helpful comments and inputs that you've provided into the final report. There we go. So this is the report that you have. This is the outline of it, and I'll just walk through and pick out some of the key findings and conclusions from the report. I wanted to particularly mention the inputs. I'm really pleased to say that we've had a very, very strong participation internationally to this report. As I say, the report has been prepared by the OECD as a collaboration between the GPFI and the OECD Task Force on Financial Consumer Protection in support of the G20 presidency. But it was very clear that delegates wanted us to work hard to get inputs from as many countries around the world as possible, in particular developing countries. And we've done that, and thank you very much to the partners that we've worked with to help distribute and circulate the questionnaire that was really the underpinning for the report. And I'm really pleased to say that 81 jurisdictions around the world have participated in the questionnaire, as I say, that form the basis for the report. And of those 81 jurisdictions, there are 164 organizations, so ministries of finance, central banks, financial regulators responded to the questionnaire and gave us inputs and information that has informed the report. And what we were looking at in this report, I guess the aim was to try and understand the impact of the pandemic on financial consumers in terms of their financial inclusion and their status as players in the market. What measures had been put in place to try and protect them as financial consumers and support their financial inclusion, and then try and identify what are the lessons we can take from that and what seem to be the most effective approaches that can inform both the menu of policy options, of course, and longer-term policy thinking and developments as well. So in terms of the impact, this slide just sets out the main risks that respondents told us were being faced by financial consumers from the pandemic. And overall, the number one risk was reduced financial resilience of consumers due to reduction in income as a result of measures put in place to tackle the pandemic. Now, of course, this is not surprising because the pandemic has impacted financial consumers in so many ways in terms of loss of income, loss of business opportunities, unemployment, and so on. So the impact on household finances has been significant. What's interesting from this slide, or one of the things that we noted, was that there was a difference in the reporting from high-income countries compared to low- and middle-income countries about the key risks. So the number one risk for low- and middle-income countries was indeed this reduced financial resilience, whereas for high-income countries, the number one risk reported was vulnerability to financial scams and frauds. And there we've seen the evidence told us that the sorts of scams and frauds that were most common were phishing scams or sort of online identity theft attempts, and also fake schemes designed to tempt people to invest in sort of fake schemes, very often through social media and very often linked to sort of fraudulent schemes to do with the pandemic itself, such as fake fundraising schemes for cures and that sort of thing. Oops. Sorry. One of the most significant impacts that we found through the research, and of course, as we know well, a trend that predated the pandemic but has been significantly accelerated, is the digitalization of the financial services sector. Many jurisdictions have observed an increase in the use of digital platforms by consumers and an increase in the entry of new digital financial products and services. Rapid uptake of such products, including digital wallets, QR codes, contactless cards, mobile trading apps and platforms, and so on. At the same time, overall, we've seen a decline in the use of cash and the number of ATM transactions and the availability of bank branches. In terms of contactless payments, we found that 3/4 of responding jurisdictions had increased the limit for contactless payments, and those limit increases ranged from between 50% of the original limit and 200% times the original limit. So I think what we could see from this is, of course, digitalization has been incredibly significant and beneficial in mitigating the impacts of the pandemic on financial consumers, but of course it also comes with other risks, and the risk of financial exclusion, particularly for groups that may not be comfortable using digitalization or have low levels of digital capability. And I know we've touched on that through other presentations as well. Some of the measures that have been put in place to support financial inclusion and also financial consumer protection. The most common measure in terms of financial inclusion was to promote the use of digital financial products and services. So we saw that governments and authorities have taken steps such as waiving or capping transaction fees and transfer fees, as I said, increasing the limits for contactless payments and digital transfers, encouraging digital onboarding, e-signatures, and digital communications. Also, many respondents reported initiatives to expand the use of digital channels for government payments, both to and from individuals, so taxes, permit payments, other fees, the payment of salaries, government benefits, disbursement of pensions, and so on. We've talked a lot today and yesterday about measures and vulnerabilities faced by particular groups, and in terms of the overall measures to support financial inclusion, we have found through the research that yes, indeed, many countries have implemented programs or measures to support particular groups. The most common group mentioned was MSMEs. I know that's been comprehensively covered by other reports, so I won't go into that in detail. Also seniors, of course, seniors have been significantly impacted by the pandemic, and in terms of financial consumer protection and financial inclusion, they tend to have lower levels of financial literacy, digital capability, and obviously have perhaps different needs, or some of them anyway, for access to products and services. So we saw many jurisdictions had put in place or launched awareness campaigns targeted at seniors, particularly focused on looking out for scams and frauds. And in some jurisdictions, there were particular special requirements on opening bank branches, particular hours, especially for vulnerable and elderly consumers. The position of women has been discussed a number of times, and yes, we've seen measures and programs put in place to support the financial inclusion of women, such as cash transfer programs, expanded deposit services in rural areas, and a whole host of training programs to support the digital skills of women and their financial literacy, particularly women entrepreneurs in many countries. On the financial, on the financial consumer protection side, many jurisdictions, the majority, have adopted policy or regulatory changes in relation to their financial consumer protection laws and regulatory settings. The most common of those was to put in place new or enhanced arrangements for consumers experiencing financial difficulty or hardship. The most common measure was moratoria or payment deferment schemes for people with holding credit, home loans and so on. And so a number of these moratoria schemes were put in place at a statutory level, and in other countries they were at an industry level. But suffice to say that these schemes were, of course, designed to make sure that consumers were able to take a break or pause from meeting loan requirements if they were otherwise impacted, or if their income was impacted by measures put in place to tackle the pandemic. In relation to insurance, which is also another very important consumer financial product, of course, we found a number of jurisdictions have put in place enhanced disclosure and information for insurance policyholders, as well as schemes to put in place to allow people to defer premium payments, to suspend cancellation of insurance contracts and so on. And I think it's probably fair to say that a lot of these measures, while initially they had very much a sort of a short-term crisis element to them, what we've seen is the extension of a number of these measures as the pandemic has gone on. And of course, then thinking about, well, the longer-term implications of those, or what do we want to pick out of those and put them into sort of long-term policy settings. We also touched on innovation as well. Asked about innovation, and yes, we found that many jurisdictions had policies and strategies in place to support digital innovation in terms of the regulatory system doing what it can to support digital innovations to come to market where there are benefits for consumers. This is often through regulatory sandboxes, innovation hubs, or tailored regulatory guidance. And in most cases, financial inclusion and financial consumer protection are important objectives in these digital innovation strategies. We also asked about changes in supervisory practices, and this is where our colleagues in FincoNet, the Market Conduct Supervisors Network, were very helpful, because we found that many market conduct supervisors had to adjust and change their supervisory practices in response to the conditions of the pandemic, and there's been a significant acceleration in the use of SupTech to support market conduct supervision. All of this is explained, of course, in more detail in the report itself. And then to come to the concluding parts, the lessons learned and the effective approaches that, of course, are put forth in this report and have informed the menu of policy options. This slide just sets out what we thought were some really interesting verbatim quotes from the responses that we received to the questionnaire. And you can see here how across the board respondents told us over and again that the pandemic experience has reinforced the importance of financial inclusion policies and financial consumer protection policies. It's really strengthened and reinforced the need for, and highlighted the need for these policies, particularly consumers who may be particularly vulnerable, as we've discussed. The lessons that we have been able to distill from all of the research and inputs and that we have studied in producing this report are set out on this slide. As I said, the pandemic has really highlighted the importance of robust financial consumer protection and meaningful financial inclusion. Digitalization is obviously, the massive increase is here to stay. The pandemic has exposed new vulnerabilities, and particularly people who may not have considered themselves vulnerable before have found themselves to be so given these circumstances that we've been facing. The effective approaches, there are 10 of them. They're on these slides. I won't go through them one by one, but suffice to say they are presented in the report. They fed into the menu of policy options. They're around things like ensuring that we have flexible hardship arrangements in the context of consumer protection frameworks, looking to harness digitalization, strengthening coordination between stakeholders and all the government agencies that are relevant here, the importance of redress mechanisms, particularly addressing the risk of online scams and frauds. That's difficult, requires a coordinated effort. Digital IDs and customer due diligence requirements, enhanced monitoring, and finally, one thing that's very important that we found is putting all these measures in place has been incredibly effective, but at the same time, they needed to be accompanied by really clear communication so that people actually knew, well, what is the measure and how do I actually make use of it? And I think that was a fairly iterative and learning process in a number of jurisdictions to get that right. So thank you very much. I know that's a very quick run through, but I know time is against us. Thank you, Magda.
Thank you, Miles. Thank you also for being a bit quicker than expected. We are running a little bit late, but I think Miles gave you the feeling of how much material was gained during this year about financial consumer protection, about approaches that have been put forward by countries. I think somehow the challenge, by listening to the two of you, is putting together these lots of experience, of country policy experience, with solid theoretical foundations. So I think we should work on bridging the gap where there is one, and the path, as Jonathan told us, is effective evidence-based policy. So I think we now have a lot of material to work on that. And now, before some discussion together, so if there are questions, just put them on the chat, we asked a few countries to exemplify their experience in terms of consumer protection during this pandemic. We have 3 countries. I will ask them to be very short. Thank you very much. We have first Richard Monks from the UK Financial Conduct Authority. Richard.
Magda, thank you very much, and thank you to you and to Anna and to the GI and to the G20 Italian presidency for arranging this fantastic event over the last few days. And Miles, thank you for summarising in such a short time period that fantastic and very significant report. And as chair of the G20 OECD Task Force for Consumer Financial Protection, I just wanted to add my thanks to everybody in this group for their contributions and participation. So I just want to highlight 2 particular initiatives that the UK did in response to COVID, but also to take a step back and think about what that could mean in the longer term. And I'll build on some of the comments made by Professor Zinman as well. So the first major initiative within the UK was in respect of forbearance. So we issued some clear guidance on forbearance to banks and to credit institutions in the UK, covering mortgages, covering consumer credit, covering overdrafts. As a result of this, over 4.5 million payments were deferred under our guidance, and our analysis after the event suggested that over 70% of people would have failed to keep up their repayments had we not issued that guidance. The reason I highlight this is that this is a very different approach to traditional regulation. Previously, this would have been seen as a commercial decision for banks and financial institutions. And of course, these banks and financial institutions had not done anything wrong. Nevertheless, we thought we needed to act and act quickly because the firms and the market weren't producing the right end results for consumers and end users. So we intervened to ensure that consumers wouldn't lose houses or cars or secured products, and in fact wouldn't have impaired credit ratings as a result of the pandemic for things outside of their control. So it was a very different regulatory approach. Instead of looking at rules and compliance and firm behaviour, it was focused on outcomes for end consumers. The second example I want to talk about was in respect of a dispute between the major UK insurers and SMEs who had taken out a product called business interruption insurance. And in this case, effectively, the SMEs wanted to claim on business interruption insurance for COVID. So in this case, the FCA actually brought the legal case on behalf of the SMEs, and we brought this case to court and were successful in helping the SMEs clarify the requirements of this particular aspect of their insurance. So the insurers paid out, and in fact, a lot of those businesses survived as a result of that intervention. Now again, this is a very different approach to traditional regulation. We would normally have considered this a commercial dispute and wouldn't have got involved as the regulator. Again, we acted quickly, focusing on the outcome of what we wanted to achieve, as opposed to strict compliance with regulatory rules. So two approaches, very, very different from the past. Now, earlier this year, Hélène Laurent, who's the CEO of Consumers International, came to speak to us at the G20 OECD Task Force earlier in the year. Her feedback on regulatory responses was very positive to COVID, but there was a sting in the tail, I think the Latin in cauda venenum, as we are in Rome. The world has seen, she said, how governments and regulators can act quickly in a crisis to improve outcomes for households and SMEs. But the sting in the tail, she said, was that now expectations of consumers, of consumer groups, was so much higher. Because if governments and regulators could act this way during the crisis, then there was no reason we shouldn't act this way in normal times. And as we've heard from the presentations today, with such a higher percentage of the population and SMEs becoming vulnerable and needing support during the crisis, both the state and the regulators were helping those individuals and those SMEs, so which will create a greater focus on vulnerability and on helping the most vulnerable in future. So we now think there is this greater expectation for regulation to deliver, for governments to deliver, and for the financial services industry to deliver in the interests of all consumers, including the most vulnerable. There's an expectation to act quickly. And building on Professor Zimmerman's comments, to think not just about the rules, not just think about traditional regulatory solutions or assumptions, not just think of disclosure or competition or rational consumers acting in their own interests, but really think from the outcome we're trying to achieve for consumers, for households and SMEs. So in conclusion, the pressure is on, I think, for governments, for regulators and for the FS industry to truly make the industry work for all. So we have a great opportunity, and I think it was Albert Einstein who said, out of crisis becomes opportunity. So I think we're in a really positive space to now take forward the agenda of consumer financial protection and financial inclusion. Thank you.
Thank you, Richard. Yes, I think all conduct authorities during this time felt a very strong pressure. So I think we can transform that into a positive force that will bring us forward. Now, Adi Budiarso from the Ministry of Finance and Unita Resmisari from the Central Bank, both of Indonesia. Please, the floor is yours. 5 minutes. Thank you.
Thank you, Magda, and also Italian presidency for having this excellent symposium with excellent speakers. Good afternoon and or good evening to all colleagues, fellow GPFI members, and I'm speaking here on behalf of both Minister of Finance and also the central banks. As we are all aware, financial services, including the payment system, have been widely supported by innovation in digital technology infrastructure. And as has been explained by Miles in the OECD report, the COVID-19 pandemic has further accelerated the use of digital technology for various economic and financial transactions. The challenge of low digital literacy is more profound for those in a vulnerable and undeserved group, such as low-income and less educated people living in remote areas, and elderly people, which is caused by a number of factors such as lack of digital and or financial skills, as well as low access to digital technology and infrastructure. However, along with this benefit of digitalization, there are some potential risks arise, such as the misuse of data fraud and scam, and even financial exclusion, as has been explored in the OECD report. And what is our measures in our country? First, in order to protect data used in electronic activity, our government has enacted a law concerning electronic information and transaction law. The law ensures the confidentiality and safeguarding of data, and this becomes the emerging standard in the digital era. Moreover, to support the global standard, Indonesia has committed to support the automatic exchange of information initiative. Secondly, with the intention to prevent from fraud and scam, Indonesia Financial Services Authority, or OJK, conjoined with the related ministries and regulators, including Bank Indonesia, have formed the Investment Alert Task Force. And this formation of the task force specifically is in order to prevent unlawful actions of public fund accumulation and investment management. Well, in order to overcome the risk of financial exclusion, as already stated also in the OECD paper, Indonesia has implemented several measures, like the use of digital financial product and services. In regard of this issue, Bank Indonesia has introduced QR Indonesian Standard, or QRIS, as a common payment method using QR code that can be utilized for all payment platforms provided by various digital payment providers. And Indonesia has also expanded the digitalization of government payments, especially for social program. And third, accelerated the digital literacy through the national movement of Proud of Indonesian Product. This movement is aiming to digitalize 30 million of our SMEs by 2024. Well, to mitigate the impact of the pandemic on the economic and society, Indonesia has implemented a range of support measures while also strengthening the financial consumer protection. We would like to emphasize first is in order to support society and SME in overcoming financial difficulty, OJK, the FSA, has issued preemptive policy concerning the banking credit restructuring, especially for SMEs. While to strengthen the consumer protection, OJK has several initiatives such as the financial literacy and inclusion to 10 targeted group, and also the financial education and campaign to improve financial literacy and resilience. While for Bank Indonesia, we also enhance our consumer protection by ensuring the well-functioning of our four strategic action through the policy, market conduct supervision, complaint handling, and also financial education. To enhance policy and regulation, Bank Indonesia has issued Bank Indonesia Regulation on Consumer Protection, along with the 3 supporting regulation, which has been issued recently to provide the further and more detailed guidance. Bank Indonesia also performed.
Can I ask you one more, because we also have Adi to talk. Thank you.
Adi I'm speaking on behalf of Adi as well. So it's all 5 minutes. So Bank Indonesia has performed its mandate to implement the market conduct supervision to ensure the financial service provider follow the consumer protection principles. Furthermore, to respond to both new challenges and opportunities brought by the digitalization, Bank Indonesia is exploring the possibility of the application of supervisory technology strategy and tools to enable more effective market conduct supervision.
Thank you very much.
Has,
Can I ask, Unita, if Adi has to talk? Is Adi not talking?
No, Adi is not talking, so I speak on behalf of both Bank Indonesia and Ministry of Finance.
Okay, then go ahead.
All right, thank you. Bank Indonesia, okay, I continue then. The third initiative we have is Bank Indonesia implemented the online digital consumer complaint system called the Customer Relation Management or CRM. While utilizing our regional representative office throughout Indonesia to handle the consumer complaints in each region. Additionally, Bank Indonesia strengthened the consumer awareness and literacy through the financial and consumer protection education, including the topic of the digital financial literacy. Our education program also aiming to empower consumers to recognize the risk of financial transaction and how to get the resolution of a dispute. Finally, from our experience, we learned that to have an effective and a significant impact of all the approach above, we believe that the key is the synergy and collaborative actions of all stakeholders, including government institutions, private sectors, including SMEs, and the society, including the people in university or academies. That's all from our intervention. Thank you, Magda.
Thank you very much. A lot of interesting experiences on the use of digital instruments to improve inclusion of both individuals and micro and small enterprises by leveraging on digital financial literacy, but also on conduct supervision. So thanks a lot. And now we have Katherine Gibson from the Financial Sector Conduct Authority of South Africa. Katherine, the floor is yours. 5 minutes, please.
Thank you very much. Are you able to hear me?
We can hear you. Let's see if we can see you as well.
Yeah, thank you. I think this is where technology can work, is phenomenal when it works really well. When you can't get it to work, however, there are stumbling blocks. Good afternoon, everybody, and apologies that you aren't able to see me. Are we able to put the slides up so I can see those?
We cannot hear you too well, Katherine. But we see your slides. If you put them on presentation.
Can you go to the next slide, please? Hello?
Yeah, we can see them. If you run them.
Yeah, next slide, please.
Okay, they can show them, and you can just tell to move them.
And then next slide. Thank you very much. All right, so I think, and alike to what the previous speakers have referred to, the main issue, I think, for us was one of the need, what we recognize is the need to be really visible as a regulator, not afraid to step in, but of course in a responsible way. It requires data. Really, the big ticket items here are visibility, having a strong presence as a regulator that relies on good quality data in real time, and that allows you to be responsive. So we in South Africa also took a range of different measures, as are illustrated here. Retirement funds, nearly half took or required interventions to be able to give contribution relief to their members. We were engaging insurers in terms of premium increases that related to the COVID deaths and responding to those and whether that was fair or not. Similar on the business interruption. Actually, this is, I think, both on the interruption and on the engaging insurers relating to the premium increases, it really is illustrative of us not just waiting for reporting to come in and not just taking a big stick either, but actively engaging the industry on an ongoing basis. And that requires really good communication and channels of communication to be examining practices for fair treatment and potential consumer harm before it can become too endemic. On the business interruption, we too, understanding that there were the court cases underway, both in South Africa and internationally. The British ones preceded ours, the English ones. We were able to negotiate a kind of a pre-court settlement for our for policyholders, which enabled almost instantaneous relief, as opposed to having to wait for the court decisions to come through. A kind of a knock-on effect, and this goes to the need for kind of active engagement, active presence, is also the response of banks increasingly closing branches as they shift to a digital network. And some of the implications, the potential for financial exclusion there. In South Africa, we have a large rural population, also a lot of illiteracy, never mind financial illiteracy. And again, that is something we're going through now, engaging the banks, looking for, making sure that the banks themselves are self-evaluating and taking steps to help and assist consumers. I think there is also a recognition of the need for us to be leveraging technology as well. We have increasingly been relying on social media scanning, sentiment analysis, and as a result, well, on the back of that, also being quite strong to communicate to consumers. I think that's been where we've struggled a bit, perhaps, is not so much with the communication with the regulated entities, but communication with consumers, and particularly vulnerable consumers, to understand and know what their rights are. Can you go to the next slide, please? This just shows some of the response, the feedback that we've been getting in terms of, this actually comes from our financial literacy survey, showing how the impact on consumers in South Africa and how more have been regretting their financial decisions. For us, this is just indicative of the kind of research, ongoing research, scanning that needs to happen. We're going to need to delve deeper into this to understand what's happening in the country that's driving, or particularly driving, this kind of response out there. Next slide, please. And lastly, it has been, I think, referenced as well. We've also had to change our supervisory, or we are in the process of changing our supervisory approaches anyway. And this has been all the more emphasized by COVID, and the need as a regulator to be really monitoring outcomes in the sector. So South Africa was a pilot in the CCAP study last year, and this year, running into this year, developing an indicator, an outcomes-based, consumer-focused indicator framework. This is something which we already are embedding into South Africa, and I think it just really goes to highlight the importance of a cross-section of powers, data sources, monitoring tools and techniques, in addition to which the kind of the cross the wide basket of tools that as regulators we need to be able to take the necessary actions as required. And it's not, and it ranges from kind of the more soft engagement through to harder kind of penalty type responses. But thanks very much. That's all from me.
Thank you very much, Katherine. Well, a lot of different and interesting approach. There is some common issues like those coming from the pandemic, issues like the increasing fraud and scams that I think all of us have experienced. But then there are specific issues that are very interesting, like the issue of regrets of consumers after financial decisions. That's interesting, and it would be interesting to see whether it just comes from many more financial instruments being available or whether there is something else. But we have at least one question from the public, from UN Better Than Cash Alliance, about the issue of the availability of gender disaggregated data. I imagine that it's not only gender disaggregated, but also other groups disaggregated data to design better conduct policies. So any of the speaker would like to respond? Jonathan Zinman, are you still with us? Would you like to respond? Oh, Ruth,
Magda,
would you like to?
Could I clarify? Thank you. Yesterday, Leora and Matt and the Queen and Professor Pandey all spoke very eloquently about how women were specifically challenged as a result of the pandemic. And yet we haven't had any data today that actually addresses that challenge. And given the fact that the GPFI has taken a leading stand on the importance of women's digital financial inclusion, and given the fact that we all know that it's a big challenge in the pandemic, I would really be interested in Professor Zinman and other people being able to say, well, how can we address that data? You said his point on evidence was fantastic. So we need evidence. We need to be able to understand women's exclusion as a result of the pandemic.
Yeah, so Professor Zinman, would you like to say something?
Sure, I don't have much to say other than to just affirm that the value of gender disaggregated data and granular data generally is quite high and an essential input. I'm sure there are others that can better speak to what data is and is not available at this moment.
What can we do to solve the problem?
Well, I think this is a very challenging question. It's in a sense, I think it's more a question for all of us on how do we aim to face this issue. It's really a question for institutions, well, public and private, how to deal with this, to give, researchers more granular data to do, better even policy analysis. So I think we can take this as a challenge for continuing our work, in a sense. Are there any further question? Then I think since we are running a little bit late, I would close this session without being able to summarize it because there were lots of inputs. I think in a sense the main challenge remains the one that I was saying before. We have a lot now of evidence. We have a lot of policy responses from financial conduct authorities that are growing in many countries. They are actually building up their experience. So I think it's time that we try to bridge this gap between what we are trying to do, all of us, as supervisory authorities, and what research, what theoretical analysis tells us to make it more solid, more effective in terms of consumer protection and financial inclusion. So really thank you, all the participants to this panel. And we can move to the last very short session. I would like to give you just the flavor, if you can put the next slides, just a flavor of the final output of GPFI this year, which is actually the result of all the work done together with Anna and together with the implementing and affiliated partners and member countries. Our objective during this year was to identify policies that really helped addressing the pandemic in terms of financial inclusion, of course, but then really allowed a leap forward, something that helped people and micro and small enterprises during this difficult time, but also helped exploiting this opportunity in leaping forwards. And of course, building mainly on digitalization. Let me go. Okay, so the main areas through which we addressed this question were three. The first refers to how to address directly the impact of the crisis, but already starting to think ahead with a longer-term view. And we tried to detail it with some specific key policy options. I'll read you just one, but the others will be available, as Anna was saying, after they have been delivered to finance ministers and central bank governors. The first one, for example, is supporting individuals and Msmes by incorporating the hardship arrangements that have proven to be very effective into financial consumer and Msmes protection frameworks in a stable way, in a structural way. So take the lessons of the crisis to think forward and make what works stable to increase protection and increase inclusion. The second area refers to how to leverage on digitalization, how to size the opportunity from digitalization for a leap forward in financial inclusion, to jump in a different world, as Anna was telling us before, in a way to be really visionary. And here we have again some examples. I will tell you just about some. For example, the first is favoring protection by design for new digital financial products and services. That is, try to require to producers to keep the objective of consumer protection and financial inclusion into account already when they design new financial services and products. And this is a message for all of us, for all supervisors, policymakers, conduct authorities. And then there are many others, like using behavioral insights to improve financial consumer protection. Some of us already use it, but maybe not enough, but also financial education. And yesterday, I think Professor Rajan gave us some examples of these. And the third area is on the other hand, to try and avoid that digitalization comes with increased risks for those who are already included. There is risks coming directly from digitalization, but also risks of excluding someone who has difficult access to digitalization. And here, the policy options include identify specifically, with a lot of effort, the risks, the groups that are more at risk, or what we have all experienced, addressing risks of frauds and scams, but also introducing or strengthening, if we already have them, redress mechanism to protect consumers when something goes wrong. And this is necessary to increase trust into the financial sector. So I think with this, we have set the way for working together also in the next few years. We hope they will be really useful for policymakers. We have developed together with our colleagues, member countries, implementing partners, and annex with examples, good practices that can be taken on board almost immediately by policymakers. So I want to conclude this by thanking really all of you for the huge effort that everybody has put into this product that we hope will be really, really useful. Thank you very much. And now I think a few words by Anna and myself.
Yes, thank you very much, Magda. I will be also very brief. I would like to thank everyone again, all speakers who presented yesterday and today, all participants who were in this room and online all over the world. And Magda just presented at the end the menu of the policy options and also mentioned that we developed together with implementing partners, 6 important reports. Of course, we still have a lot to do in order to produce, to find new data, and we will discuss actually tomorrow at our plenary meeting some ideas on that. Of course, we need more evidence. We need more understanding what approaches work, as Professor Zinman today also put it very well. So we know that we have a lot to do, but what is also important, we produce these reports all together and put a lot of efforts in it, but the key is implementation. So I would like just at the end to say one word that I would like to ask all who participate in this event to learn these documents, to share them with your colleagues in your organization, to promote them in your countries, and to use it for the benefits of financial inclusion, financial resilience, and financial well-being of our people, our population. So I think that implementation is key, and we are ready to help you in that. Thank you very much again, everyone, and thank you, of course, Italian team, the whole Italian team and Italian presidency, Central Bank and Ministry of Finance for organizing this great event. Thank you. And thank you, of course, my dear co-chair Magda, for all this work done. Thanks a lot.
Thanks a lot, Anna, and let me conclude. I don't want to say anything more. Anna said everything. We will continue to keep this dialogue open with, of course, all member countries, but also with other stakeholders, because I think it's very relevant that we keep this dialogue open, and I think we can commit to that with Anna. But let me conclude now by thanking all the speakers, all the participants here online for their very rich contributions, the questions, and also our colleagues for the logistic support. It has been wonderful. Carmela, Lorenzo, Andrea, Carola, if everything worked well, we owe it to them. Also to Andrea Pacifici for the connections. And let me thank the Italian delegation and my supporting team. They have been wonderful through this year. Maria Iride, Daniela, Alessio, Elisabetta. I think they have done a great job. If everything really worked well this year, I at least owe it to them. So thanks a lot, and looking forward to seeing all of you again soon, next year, under the Indonesian presidency. Thanks again. We are off.